RRSP versus TFSA. Which one actually puts more money in your pocket over time? It's one of the most Googled financial questions in Canada, and yet they're one of the most misunderstood. One gives you a tax break now, the other gives you a tax-free growth later. But here's the problem. Choosing the wrong one for the situation could quietly cost you thousands in avoidable taxes or missed opportunity. Whether you're just starting to build wealth, saving for retirement, or trying to reduce taxes in a higher income bracket, this decision matters more than you think. Hi, if you're new here, my name is Charles DeCalzi, Associate Investment Advisor at Zenith Private Wealth Council, IA Private Wealth. I help Canadians, especially business owners and professionals, make smarter, tax-efficient decisions about their money. Today, we're going to answer one of the most important and misunderstood questions in personal finance. Should you contribute to an RRSP or a TFSA? The answer isn't the same for everyone. It depends on your income, your goals, your retirement plans, and yes, even what tax bracket you'll be in later. In this video, I'll walk you through the differences, show you who benefits the most from each account, and share real-world scenarios so you can make a clear, informed decision. So let's get started. So what's the difference between an RRSP and a TFSA? Let's start with the basics, but with a lens towards how this actually impacts your money. An RRSP, or Registered Retirement Savings Plan, the RRSP was designed to encourage Canadians to save for retirement by offering an upfront tax deduction. So here's how it works. Every dollar you contribute to an RRSP lowers your taxable income for the year. For example, if you earn $120,000 and contribute $20,000 to your RRSP, you'll only be taxed on $100,000 of that income. The money inside the RRSP grows tax deferred, meaning you don't pay tax on the investment gains until you withdraw it, usually in retirement, when your tax rate is expected to be much lower. But here's the catch. RRSP withdrawals are fully taxable as income. That means if you take out $30,000 in retirement, that entire amount is taxed according to your marginal tax rate at the time. Contribution room is based on 18% of your previous year's earned income up to the annual limit of $31,560 for 2024. If you're self-employed or incorporated, earned income matters. Your TFSA, your tax-free savings account, despite the name, isn't just a savings account. A TFSA can hold the same investments as your RRSPs. Stocks, ETFs, mutual funds, GICs, etc. You don't get a tax deduction when you contribute, but here's the advantage. Your money grows tax-free and withdrawals are completely tax-free as well. That means if you contribute $10,000 and it grows to $50,000 over time, you can take the full $50,000 out without paying a dime in tax. Contribution room for 2024 is $7,000. And if you've never contributed before and were 18 or older in 2009, you may have up to $95,000 in room as of 2024. TFSA withdrawals don't impact government benefits like OAS or GIS, while RRSP, RRIF withdrawals can, so in short. RRSPs, immediate tax deduction, taxable later. TFSA, no tax deduction, tax-free forever. Both have value. The real question is, which one works better for your goals and your tax profile? Part 2. Which one saves you more money in taxes? This is where things get interesting and where a lot of Canadians unknowingly leave money on the table. Here's what most people miss. It's not just about the tax deduction today, it's about your tax rate today versus your tax rate in retirement. Let's look at two simplified examples. Example number 1. High income earner today, lower income in retirement. Jenny is a consultant earning $150,000 per year. She's in a high tax bracket now, but plans to retire at 60 with a mix of rental income and RRSP withdrawals totaling about $60,000 a year. She contributes $25,000 to her RRSP. Up front, she saves over $10,000 in taxes. In retirement, she withdraws that money in smaller chunks at a much lower tax rate, possibly even below 25%. In this case, the RRSP is a clear win from a tax savings perspective and income smoothing. Example number 2, mid-income today, same or higher income in retirement. Chris is a business owner earning $75,000 but plans to sell his business at 60 and collect investment income of $90,000 annually. He's contributing regularly to his TFSA. Because his retirement income will be higher than it is now, RRSP withdrawals could actually push him into a higher tax bracket later on. He skips the RRSP deduction and uses a TFSA instead. His money grows tax-free, and withdrawals and retirements don't count as taxable income, helping him avoid the OAS clawback or moving into a higher tax bracket. Here's the general rule of thumb, though it's never a one-size-fits-all. If your tax rate is higher now than in retirement, RRSP makes more sense. If your tax rate will be higher or equal later, a TFSA gives you a better long-term tax efficiency. But it's not just about your income, you also need to factor in. Will your RRSP withdrawals trigger OAS clawbacks? Are you self-employed and need flexibility? Do you plan to retire early before government benefits kick in? Will you have deductions or write-offs in future years that reduce your tax rate? You have a spouse you can split pension income or RRSP with? This is where planning, not guessing, can make a big difference. Part 3, when to prioritize one over the other and when to use both together. One of the most common questions I get as a financial advisor is, should I max out my RRSP or TFSA first? The truth is, it depends entirely on your current and future tax situation, your cash flow, and your retirement plan. Here's how to think about it. Prioritize your RRSP when you're in a high income tax bracket today, typically $100,000 or more. You expect to have lower income in retirement, either due to lower lifestyle expenses, downsizing, or less income from other sources. You need the tax deduction now to reduce your taxable income. So for example, avoid OAS clawback or to stay in a lower marginal tax bracket. You're building up retirement savings and want to defer taxes until later. So here's a common scenario. You're a professional in your peak earning years. You contribute $30,000 to your RRSP, get a $12,000 refund, and reinvest it into your TFSA or use it to pay down high interest debt. Prioritize your TFSA when you're in a lower or moderate tax bracket, usually around under $70,000 annually. You want tax-free income in retirement to reduce your total tax bill. For a shorter term goal, home purchase, early retirement, and want the flexibility to withdraw without triggering tax or repayment rule. You already have other income sources in retirement, such as rental income, a business sale, etc., and want to avoid layering more taxable income on top. Here's a common scenario. You're a business owner taking $60,000 a year in dividends. You want to save for retirement, but avoid the extra tax that comes with RRSP withdrawals down the road. Your TFSA gives you tax-free growth and flexibility. When to use both together. The optimal strategy. The most efficient retirement plans often combine both accounts to provide flexibility and tax optimization. Here's how that might look. Use RRSPs to lower your tax bill during high income years, then withdraw strategically in lower income years. So for example, early retirement, pre-CPP or OAS, use your TFSA for long-term tax-free growth and to fund extra spending in your retirement without bumping up your income tax. In retirement, use your RRSP or RRIF, your RIF, withdrawals to top up taxable income and TFSA withdrawals to avoid triggering OAS clawback or higher tax brackets. This hybrid strategy allows you to build tax diversification into your retirement income plan, giving you more control over when and how to pay tax. Part 4. Business owners and professionals can use these accounts strategically. If you're a business owner, incorporated professional, or self-employed, your situation is different, and so is your strategy. The flexibility you have in choosing how and when to pay yourself, salary, dividends, or retained earnings, opens up a unique planning opportunity for RRSP and TFSAs. Let's break it down. RRSPs for business owners, when they make sense. RRSP contribution room is based on earned income, meaning salary, not dividends. If you're only paying yourself in dividends, you're not building RRSP room. So if you want to take advantage of RRSPs, you may need to pay yourself a salary, which increases payroll taxes, but opens the door to large RRSP deductions. So for example, you pay yourself $160,000 in salary. You get the maximum RRSP contribution room of $31,560 for 2024. You contribute that amount, save approximately $13,000 in taxes this year. This is especially valuable if you're in the 43 to 53% tax bracket. TFSAs for business owners. Why they're a no-brainer. Your TFSA room builds up regardless of income, salary, or dividend. You can withdraw at any time tax-free without affecting government benefits or your personal tax rate. No attribution rules, no repayment rules, and no tax impact on your corporate decisions. In other words, the TFSA gives you maximum flexibility, which is incredibly valuable if your income is lumpy, seasonal, or unpredictable. For example, you pay yourself $75,000 in dividends to minimize personal tax. You max out your TFSA $7,000 for 2024, invested in an all-equity ETF, and it grows tax-free over time. You now have an emergency fund, opportunity fund, and retirement fund, all in one place with no strings attached. Part 5. Real-life examples. Let's look at 2 Canadians. Sophie, 32, salaried employee, earns $90,000 a year. RRSP is perfect. She saves about 30 to 35% on contributions, and she expects to retire at $60,000 per year. She also contributes to her TFSA to give her flexibility in the future. Jason, on the other hand, 41, incorporated consultant, pays himself $60,000 in dividends. No RRSP room since he doesn't take a salary. Maxes out his TFSA each year and invests surplus in his holdco. We set up a corporate tax strategy to shelter investment income. Two totally different strategies because their income and tax profiles are different. Part 6. So which one should you use in 2025? Here's a quick cheat sheet. High-income employees, RRSPs first, then TFSAs. Low-income earner or student, TFSA only. Business owner, TFSA, plus corporate investments, RRSPs, and case by case. Near retirement, use both to manage withdrawals and benefits. Don't think of it as either or. The smart move is understanding when and how to use each tool, and that depends on your income, goals, and long-term plan. If you want help figuring out which account makes the most sense for your income, your business, and your future, book a time with me or my team using the link below. We'll build a customized plan based on real numbers and help you avoid costly mistakes. And if you found this helpful, hit the like button and subscribe for more videos on tax-smart investing and retirement planning in Canada. Thanks for watching. I'll see you on the next video.